This video is not financial advice and for educational purposes only. Fuck the hoodies, diamond hair Dave's only, and make sure you like and subscribe if you like this content. Alright, what's up everybody? Welcome to Hindsight Trading. We're going to be going over how to sell covered calls today. Our example is going to be using AMC. As you can see, the current stock price is about $12.28. We got about another hour and a half of trading, I believe, left. So let's jump right into the options contracts. We're going to be using Robinhood for my example here. We're going to be selling covered calls, so make sure you're under sell calls, because buying, selling, and puts are very different. So make sure we're under selling calls. Move it over here. Alright, so to sell a covered call, what do we need to sell a covered call? So we're going to be selling a covered call for AMC. We're going to need 100 AMC stock to start with, so we need to own 100 shares of AMC to be able to do this. And you can do this with any most other stocks. As you can see, options have expiry dates. This is on the 21st, which, by the way, today is 5/21/21, so this is the expiring date. Today is Friday. This expires in the next hour. So as you can see, that's why a lot of these contracts are almost worthless, because these are about to expire out of the money, as you can see. So to be able to do this, to be able to sell a covered call, we need shares, 100 shares of AMC. So let's just market buy AMC shares. And that's $12.28. So we're going to buy 100 shares at $12.28. So to sell a covered call, and let's say we're willing to sell whatever price, the strike price over here, when you write up this options contract to sell a covered call, what you're saying is you're willing to tie up your 100 shares with whatever price this is. Let's just say $14, and you're willing to sell at 14 by this date. So if the price hits higher than 14 by this date, most likely the person who purchased the contract from you will exercise the contract and pay you out the $14 per 100 shares. So you would get $1,400, and you would also get paid this premium right here. But as you can see, these premiums are very low because this option expires very soon, in the next hour, if you think about it. So the chance of it going to $15 in the next hour is very slim to none, as the price is, you know, $12.28. So let's just sell a $12.50 call then, right? We want to make the most money because this is about to expire anyways, and we're okay with selling at $12.50 because we bought under $12.50 each. So this contract is only 5 cents. You might say that's so little, but we're going to be getting 100 shares times 5 cents. So we're going to be getting $5 for this, which is not much. But this is going to be positive $5 added to our stack. We lost this amount. So now two things can happen by the end of the bell in the next hour. The price could climb above $12.50, and let's say it gets 13, and we would get called for our contract most likely at $12.50. So we would get paid $12.50 if our contract expired in the money, aka the price went up above where we sold it at. And the person who bought the contract from you, somebody purchased this from you, if they exercise your contract, they're going to pay you out these 100 shares, $12.50 for your 100 shares. So $12.50 plus we got a $5 from the contract as well. So instead of technically making, what is this, $22? Yeah, we would have made $22 if we just bought and sold at $12.50, but instead of just $22, we would actually make $27 total because of the options contract we sold right here. So that would be the total profit in 1 hour, which is pretty good. You know, you might say it's not much, but I mean, that's just 1 hour of quick trading and explaining options. So the other thing that can happen here, let's go back just a little bit. The other thing that can happen here is it expires out of the money. So the price stays where it's at or goes lower. Let's just say it goes towards 12 instead of 12.22, 28. I mean, it goes down towards 12. And if that happens, this contract expires worthless. So do all these. As you can see, they're already almost worthless up here. But these all expire worthless when this date ends. So once these expire worthless, you keep your $5, and your 100 shares were tied to this contract. When you write this contract up, and this is what's great, if you don't want your broker to short your shares, aka once you have your hundreds of shares, let's say of AMC on Robinhood, they can use those 100 shares and loan them out, and they get paid the interest on it. And you're basically not getting paid any interest. You're basically letting your shares be loaned out to people who are shorting it, which is not a good thing. When you tie it up in options contracts, these 100 shares are tied up to this contract, so it can't be shorted. Now they can't be shorted. So any of the AMC holders, this is what you need to be doing. If you have 100 or more shares, you need to be selling covered calls. And let's give a better example. Let's just say, like I said, it expired out of the money. We got our $5. We kept our 100 shares now. They're not tied anymore. These are no longer tied over here, right? Let's just get rid of this. Now these options are gone because we're in the next week. It's next Monday now. We have our 100 shares. We got paid $5. Let's head back to Robinhood real quick. and it's next week, so May 28th. All right, so now it's Monday. We kept our $5. We are now at a little bit less of a deficit, as you can see. And now we're going to sell another covered call. And this is the great part about covered calls. You can choose the price you want to sell at. So if you're somebody who wants to sell way higher than this, go higher in the contracts, and you can see that you'll still get paid even if you're fulfilling a $20, let's say, call. You'll just get a lot smaller premium because the higher you go, the smaller the premium gets. But let's say we want to sell another covered call. So we're going to go over here. We're going to sell a $14 call this time. This time we want to get $14. So the premium here is 43 cents per 100 shares. 100 shares times 43. So we're actually going to get paid $43 for this contract. And by Monday, these will be a little bit less technically because there's less time, because today is still Friday. This is showing the contract prices for today, May 21st, the Friday. But by Monday, these will go down a little bit because there's less trading days. So keep that in mind. These will go down as time goes down because now there's less time to fulfill these prices. So we're going to get paid 43 this time, okay? So now our average is technically down too. So now our dollar cost average is actually below $12, and we still have our 100 shares. Now they're tied to these $14 contracts. And at this point, what can happen by the 28th? So two things, same thing again. Either we get exercised for our contracts, aka the person who bought this from us, this person who paid us $43. If the price goes way above 14 by Friday, this person's most likely going to want to sell your shares because they basically own your shares for this option. So they're going to want to sell your shares at 14 each. We're going to get paid $1,400. And our deficit is over here now. So we've technically, in 2 weeks, made a profit of $220. And we sold our shares at $14 each. And what do we buy at? $12.28 each, as you can see. If you do the math, and if you would have bought the same shares at $12.28 each and just sold them at 14, the profit we would make is actually under $200. You would only make like $172, I believe, if you just bought and sold. But because we sold all these contracts, these covered calls, we made the premiums. Plus, we sold it at $14 still. Or same thing as last time. You can just continue this gimmick over and over and over again. Let's say we sold this covered call now. Our shares are tied up again. And at this point, either, the price stays at $13, let's say. It barely goes up. It doesn't go up enough in the week. It stays at 13, still below that $14 price. So the strike is like somewhere here below where we agreed to, right? So this person is going to expire out of the money. So we're going to keep that $43, and now our average is down to, $11.80. And our dollar cost average is now technically below $12, right? Because now we've sold contracts 2 weeks in a row. We got paid for both, and the price keeps going down of AMC at this point, right? Because these are expiring out of the money. That means price of AMC keeps going down, let's just say, but our average is going down with it. That's the greatest part about selling these covered calls. So now we can sell a $12 covered call, right? Because our average is technically above $12. We're okay with selling at $12 each because that's still a profit technically, right? So even though you might say that's not much profit, but look at what's going to happen now. Because we're selling a contract that's already in the money, and like I said, this is for 2 weeks out now, so once your contract is tied up, you have to wait till that expiry date to be able to resell another covered call. You can't just keep selling covered calls. Covered call means you have the 100 shares, now they're tied up to whatever call that you're doing. So these premiums won't be as high, weeks ahead. But look at this premium, 134. We're going to be getting $134 just for selling that. And at that point, let's say it expires over the money. That means we're going to get $1,200 as well. And now we made that 134 profit plus the $12, and then our negative is only 180. So we actually still made $154 total doing that. And think about it, we sold at $12, which is technically less than what we bought our shares for because we bought at $12.28 each. So we bought at $12.28 each and we sold at $12, and we still made $154 profit. So that just shows you the power of covered calls. Thanks for watching, everybody. Feel free to like and subscribe if this helped you out. If you have any feedback, feel free to leave a comment, or if you have any questions, join our Discord and we can help you out with crypto, stocks, or anything else. Thank you so much.